Welcome to this episode of Retirement Crusaders. I want to talk about 3 of my favorite dividend stocks for 2023. All right, let's dig right in. So the first stock here is called Norsk Hydro. Now, this happens to be a Norwegian-based company. They have plants all over the world. What do? They manufacture aluminum. Now, the unique thing about this company is that aluminum is a very energy-intensive business. In other words, to produce aluminum, the mining of the raw ore requires a lot of energy, and then the processing of that ore requires energy. And many companies that do this around the globe are using coal or oil or natural gas as their energy source, fossil fuels. And that is very not only expensive, but they are having the burden of environmental regulations concerning using those fossil fuels. This is where Norsk Hydro has an advantage. In Norway, the energy that they use for aluminum all comes from their own hydroelectric plants. So the flow of water is supplying the electricity to drive those plants. They own their own power source. In other parts of the globe where they have plants, 70% of those plants operate using renewable energy. So this is the big advantage they have. Now, why else do I recommend this business? First, I want you to understand when you're in a business that involves a commodity, the price is not stable. So here we see a chart of the price of aluminum over time, and it bounces around and goes up and down. That means the company's profit will go up and down. Now, at first, that may sound like, well, that's unstable. Not necessarily, because well-run companies, even when the price is down, will still make a profit. They just make a lot more profit when the price is up. Now, let me talk about the outlook for aluminum, and this is one of the reasons I like this stock a lot. As you see here, the Tesla Model S contains 1,454 pounds of aluminum from the body to the battery and the engine. Now, that's an awful lot of aluminum that needs to be used to produce a car. The beauty of aluminum is that as we proceed in time with more and more electric vehicles and even also aircraft that are powered by electricity, keeping the weight of the vehicle down is critical. And aluminum does that better than any other material on Earth. London Electric Vehicle Company. We choose aluminum as a material because it's nearly 3 times lighter than steel in its raw form and absorbs twice as much energy in a crash. Can you think of a more perfect material for which to use as the body of an automobile? Not only is it used in the bodies, but in the electric batteries that are in cars and aircraft, those batteries also require aluminum. In fact, let me show you something. Electric cars boost demand for metals. So aluminum, from between 2019 and 2030, in this 11-year period, it's estimated that the need for aluminum will go up 14 times. Now, it seems pretty sensible that if you know, over a decade, we are going to need 10 times as much as a product as we have now. And here's a company that is a leading manufacturer and a low-cost manufacturer because they have their own energy. This would be a very good company to invest in. Now, this company is based in Norway. So, like many foreign companies, it does not pay its dividend every quarter. It pays it annually. And it tends to base its dividend on its profits. So the dividend, unlike US companies, is not consistent from year to year. In good years, they're going to pay more, and in lean years, they will pay less. They have a commitment to pay about a 2% dividend no matter what. They've stated that in their annual reports, but that dividend can be higher. So in the last 12 months, that dividend was about 7%. I would expect that as time goes on, not only will the stock price increase, but so will the dividend as this company's profits increase with more and more demand for aluminum. Now, one thing to know about, many foreign companies in countries, Norway is one of them, when they pay the dividend, they withhold a 15% tax. Now, they have an agreement with the United States so that on your tax return, you can say, look, I paid 15% tax to Norway. You can take that as a credit or a deduction on your federal tax return. So you're not going to have to pay that twice. You get credit on your tax return. What I just said is true for 98% all investors. If you have an awful lot of foreign dividends, like more than $20,000 a year, the taxation becomes much more complex. But for the average investor, it's just as I explained. Now, the next company I want to talk about is Stellantis. This may be a name you've never heard, but you actually know this company well by its products. Stellantis manufactures Dodge, Chrysler, Jeep, and many other brands around the world. Maserati, Peugeot, Fiat. So even though the name of the company is not familiar to you, you will know its products. They manufacture about 9 million vehicles a year around the globe. Why do I think this is a great company to invest in if you're a dividend investor? Let me show you. Notice here the price earnings ratio is less than 3. If you've invested in stocks before, you know that basically any company that has a price earnings ratio less than 8 is low, has a low price relative to its earnings. However, you might say, wait a minute, maybe all the companies in the automotive industry have a low price earnings ratio. Well, let's take a look. Let's take a look at Ford. PE ratio 6.61. Let's take a look at General Motors. PE ratio 6.70. So Stellantis has a PE ratio much, much lower. What does that mean? It's a much better value. You're buying the shares really cheap relative to the earnings of the company. Now, if these types of educational videos are valuable to you, please hit the subscribe button below. And also, in the description, we have links to our booklets on 10 different retirement topics. Make sure you click those links. And if you like the service that I'm using that you see on my screen, which is called Seeking Alpha, we have a link. You can get a subscription, I think at a pretty reduced price or maybe a 30-day free trial. But click that link, and full disclosure, Seeking Alpha compensates us something when people subscribe to their service. So check it out. If you like it, great. If you don't, pass on. It's the service that I use for all of my investing research. Now, the other thing I want to show you about Stellantis, this is probably of most interest. The company has $47 billion worth of cash. Now, if you divide the number of outstanding shares into this cash balance, you would find that there's about $15 per share of cash that this company holds. Interestingly, the shares sell for $16. So what I'm saying is, when you invest in this company, almost every dollar of your investment is backed by cash that's on the balance sheet. You're essentially getting the business for nothing. Now, look, that cash, of course, they need in their business for operating purposes. But the point I'm trying to make is you've got a lot of downside protection in that you're buying these shares really, really inexpensively. Now, let me just go back to the chart for a minute. The auto industry has not had a good time in 2022, and it still continues in 2023 because there's still a shortage of chips. They can't manufacture as many cars as they'd like, and there's talk of a recession not only in the United States but elsewhere in 2023. So you might say, wow, this sounds like a terrible time to invest in an automotive company. No, it's just the opposite. When the news is all good, you'll be paying $40 a share for this stock. The reason you want to invest in it now is because it's in a lull period. when they can't get enough chips, they can't manufacture enough cars, there's recession. So right now, the share price of auto manufacturers is muted because of these concerns. This is a cyclical industry, meaning it goes up and down and up and down. You want to buy when it's down, not when it's up. So the timing for a purchase of these shares is really good. You'll notice it's already, I'm not the first person to notice this, it's already started its ascent, and I think this will continue for the rest of the cycle, which may be 2, 3, 4 years into the future. Okay, let's talk about my last recommendation today. My last recommendation are preferred shares of a company called Crestwood Equity Partners. Now, Crestwood is a business that does something pretty simple. They move oil and gas from one place to another. They have pipelines. So they don't really care whether the price of oil and gas is up or down, because they charge a set amount for a barrel or 1,000 cubic feet of gas to transport it in their pipelines from one place to another. In fact, many of their contracts that they have call for the customer paying for the transportation whether they actually use it or not. So they're paying for the availability of the pipeline resource. So this is a pretty good business, pretty stable business. Whether the price of oil is $50 a barrel or $100 a barrel, they tend to have consistent revenues. The reason I'm recommending the preferred shares is this happens to be an opportunity to get a super stable dividend for an indefinite period of time. So the dividend right now at the current price is just shy of 9%. And these are perpetual preferred shares, which means they are non-callable. The company doesn't have the option to call these away from you in the future. And if we looked at the financials, one of the things that's nice to see is the amount of preferred dividends they have to pay out each year, about $60 million, is only 20% of their cash flow. So they have $5 of cash flow for each dollar preferred dividend they need to pay. So the dividend is well covered, very secure. So that's my third recommendation for this episode of Retirement Crusaders. If you like what you're hearing today, please be sure, click the subscribe button below, make sure you see our future videos, and in the description, click to get any of our retirement booklets, which are free. And if you like the service that I use, Seeking Alpha, you can get a subscription at a reduced cost. Just click the link in the description. We will see you next time on Retirement Crusaders.